Okay, today we're going to talk about 3 guidelines that Forex traders can follow time after time, and it'll help them to make a lot more pips and to be more successful as a Forex trader. And this video is from forexearlywarning.com. Okay, the first guideline, and there's 3 of them altogether, is that all traders must learn to understand currency transactions, and they must understand that a cash transaction is the same as an online transaction, except for the leverage. So you can use any 2 currencies you want in this example, but if a USA citizen travels to New Zealand, they need to exchange US dollars for New Zealand dollars. They'll have money to spend when they get to New Zealand. So if they buy $10,000 US dollars worth of New Zealand dollar, if they come back from their trip and they still have some New Zealand dollars, when they come back from the trip, they can exchange the New Zealand dollars back to US dollars. So this is like a round trip, buying the New Zealand US dollar pair and then closing the transaction if you're doing an online transaction. So the only way you can make a profit from a cash transaction or an online transaction is if the New Zealand dollar was to strengthen, or if the US dollar was to weaken during the time that they were on their vacation. They can make a small profit on the transaction. And the thing that you have to remember is that it works the same way for a cash transaction or an online transaction. It doesn't matter. So you want to look at the exchange rate, and that's all that you care about. Did the exchange rate go up or down? Did the New Zealand dollar strengthen or weaken? Did the US dollar strengthen or weaken? So individual currencies. The second guideline is currency pairs only move because one currency is strong and the other is weak. So if the exchange rate for the New Zealand US dollar goes up or down, that's the only thing that matters. And that technical indicators, if you attach them to the pairs and you do not consider what's happening with the individual currencies, you're making a giant mistake. If you look at the way a currency pair is constructed, you have your base currency and your cross currency. It doesn't matter what pair it is. The base currency would be on the left. Well, if you use technical indicators, there's a lot of technical indicators. There's over 150 technical indicators and 100 candlestick charts formations, and absolutely none of them work. None of them. But if you start looking at all these indicators, you can come up with millions of combinations, and it just turns out to be a gigantic waste of time. So after you exchange currency, nobody looks at technical indicators. If you do a cash transaction, all they'd look at is the exchange rate, and the only thing that matters is whether if the base currency is strengthening or weakening and the cross currency is strengthening or weakening on a cash transaction, and it's the same exact thing on an online transaction. So it's a very simple concept. Most currency traders know it's always the strongest and the weakest currencies that if you pair them up, you're going to make some pips. But they still use the technical indicators, the standard indicators like the Fibonacci's and the RSA and the envelopes and all the garbage that's out there. And they keep expecting them to work, but it doesn't. So what you have to do is you have to start analyzing each currency separately. If you want to make a trade on the Euro USD, you have to analyze the Euro separately, and then you have to analyze the USD separately. You have to split them up. You have to split up every currency pair into 2 pieces and then analyze each individual currency separately. Okay, here's guideline number 3. Not recognizing that there are 2 individual currencies in each pair and the need to analyze each currency separately will basically kill all of your entire Forex trading until you accept this basic principle. If you're using indicators, you'll destroy your trading. If you're analyzing individual currencies, you have a real chance to make profit in pips. So let me give you an example. If you want to buy any one of the euro pairs, okay, let's say you want to buy the euro yen, for example. Let's say you want to buy the euro yen. The very first step is to separate it into two pieces. You analyze the euro first. Well, how do you analyze the euro? You line up all of the euro pairs against the major currencies all together, and you look at the trend and the current momentum, and you will have a solid foundation for trading the euro yen. If all of the euro pairs are rising, you have a real good chance, or trending higher, you have a real good chance to make money and pips trading the euro yen. If the euro is strong, you want to find one of the cross currencies that's weak. Let's say the euro is strong across the board and the Swiss franc is now weakening, then the best pair to trade would be the euro Swiss. Okay, here's a real-time tool that's called the Forex Heat Map. It measures euro strength, and it also works on 8 different currencies. So if the euro is strong, it'll show euro strength in real time, and it'll tell you, hey, the euro is strong, the New Zealand dollar probably has a little bit of weakness, therefore the best pair to trade would be the euro New Zealand dollar, but there's other pairs like the euro USD that are moving up just fine. It's an excellent tool to work with your Forex trading. And by the way, you know, I mean, technical indicators just won't give you this information. It's just technical indicators are just bad. So if you're using technical indicators or robots or whatever the case may be, you need to just abandon the technical indicators, you know, the Fibonacci's, the RSI, the envelopes, and all the crazy indicators that are out there, and just go with the individual currency analysis. So how do you put these 3 guidelines into action? Well, you have to analyze individual currencies. And so one tool that you can use is called the Forex Market Analysis Spreadsheet. This is a spreadsheet, and it's you can link right to it here. And it's for analyzing individual currencies. For example, if you want to analyze the US dollar, you just fill the spreadsheet out to determine if the US dollar is weak or strong. It's a fantastic tool, and it's free. Another tool that you can use is the tool that I just showed you a minute ago, the Forex Heat Map. This is the live indicator that tells you what currencies are strong and weak. So these are all the USD pairs. So you can immediately tell by looking at this live indicator that the US dollar is weak. And it's immediate. You just look right at it and it takes you 10 seconds to figure it out. The heat map actually has 8 different currencies on it, all stacked on top of each other. So you can have a map of the market. If you want to learn more about the Forex heat map, you can click right there. Teach all about this. Is an example of euro dollar strength. Here's an example of New Zealand dollar weakness, because the New Zealand dollar is the base currency and the cross currency in the New Zealand dollar group. So you can start demo trading with these really simple techniques using individual currencies, the Forex market analysis spreadsheet, analyzing individual currencies, the trends, and all of a sudden you are building a great trading system. So if currency traders move away from the technical indicators and towards individual currency analysis, their results will get tremendously better very fast. And so these are the 3 guidelines for winning trades. And remember that all online transactions, if you're buying and selling a currency pair, it's except for the leverage, 50 to 1, 100 to 1, whatever you're using, it's exactly the same as a cash transaction. The only thing that matters is the exchange rate and what's going on with the individual currencies if you want to make winning trades with online or cash transactions. So thanks for listening to this great lesson from ForexEarlyWarning.com.